Hello. We will analyze Chapter 6 together today, International Bank Regulation and Supervision. In this chapter, the topics are examined under domestic regulatory regimes to understand the fundamental aspects. Based on Basel I Accord, the original Accord outline, the Market Risk Amendment under that one, Basel II Accord set aside capital cushions against potential credit, market and operational losses. Basel III Accord, a global regulatory framework for more resilient banks and banking system. Let us firstly analyze what is domestic regulatory regimes. Bank regulation and supervision has two fundamental objectives. The first one is to ensure prudent practices at the individual bank level through the impositions of capital standards and operational guidelines. And the second one is to reduce systemic risk through individual bank examinations and system-wide assessments. After the crisis that we analyzed under Chapter 4 and 5, the Basel I Accord is needed. The 1988 Basel Capital Accord was the international regulatory response to the threat to the stability of the global financial system posed by the 1980s Latin American debt crisis. Initially approved by representatives of the G10 countries, then the only members of the BCBS, Basel I was eventually adopted by over 120 countries. As outlined in Basel I, a bank's capital, which is shown by K, should be at a minimum 8% of the sum total of the bank's assets, each asset weighted by its credit risk. And you can see the formula there. K must be greater or equal to 8%. That was the first written under the Basel I. So let us look what is the definition done under Basel I, because it will change for Basel II and III later. K has two components, Tier 1 and Tier 2. What is Tier 1 or core equity? Comprising issued and fully paid common stock and non-cumulative perpetual stock plus retained earnings. Tier 2 or complementary capital includes comprising cumulative perpetual preferred stocks, subordinated term debt with minimum maturity of 5 years, and undisclosed or non-specific reserves. What is the regulatory framework for Basel I? We have four major criticisms from the banking industry. It failed to properly differentiate between private sector credit risk. In other words, the same risk weight would apply to a large AAA corporation and a startup business. Second one, it's OECD, non-OECD distinction was arbitrary. Third one, it failed to deal properly with important changes that had begun to take place in the structure of banks' balance sheets away from typically hold-to-maturity loans to securities traded in the secondary markets. It failed to acknowledge of the latest developments of modern finance, including the beneficial effects of diversification to risk mitigation, being incorporated into banks' internal risk management models and techniques. And later on, Basel II was needed. The Basel II Accord, introduced finally in 2004, consisted of 3 pillars intended to strengthen the safety and soundness of the financial system. Pillar 1 is for minimum capital requirements, Pillar 2 supervisory review, and Pillar 3 for the market discipline. Minimum capital requirements establishes guidelines for the minimum capital cushion banks should carry to protect against credit markets and operational losses. Supervisory review complements Pillar 1, setting out principles for the examination process that regulator should engage in to assess the quality of a bank's risk management procedures and internal governance, including board of directors' involvement and accountability. Market discipline establishes guidelines for the external disclosure of a bank's overall risk position to depositors, counterparties, investors, and the public at large. For Pillar 1, we have to just have minimum capital requirements. The Basel II Accord required banks to set aside capital cushions against potential credit, market, and operational losses. The Basel II Accord proposes 3 alternative approaches to determine credit risk capital. First one is the standardized approach. Second one, the foundation internal rating-based foundation IRB approach, and the advanced internal ratings-based approach. According to Pillar 1, what will be the market risk capital? Market risk is the risk of loss for a bank due to changes in interest rates, exchange rates, and the prices of securities and commodities. The Basel Committee on Banking Supervision's first formal acknowledgement of concern with minimum capital requirements for market risk came about in 1996 through the issuance of the Market Risk Amendment to Basel I. And operational risk capital, that was under Pillar 1 also. Operational risk is the risk of loss as a result of failed internal processes due to human error or system disruption or external events. Examples of human failures include technical processing and control errors, including fraud. System failures include breakdowns in front office functions, such as the settlement of transactions among customers or between customers and the bank, or back office functions, such as the internal booking of transactions and reconciliation of accounts. What will be the determination of operational risk? Basel II offers 3 basic approaches for the determination of operational risk capital. First, the basic indicator approach, where operational risk capital should be at least 12.5% of the bank's operating income before tax. Second one, the advanced measurement approach, which allows banks to use their internal model to assess operational risk and quantify the necessary capital cushions. And the third one, the standardized approach, which allows banks to determine the necessary capital charge under closed supervision of regulators. Here we have another definition for Tier 1 and Tier 2, which are detailed under Basel II. Tier 1 or core is defined as common plus non-cumulative perpetual preferred stock plus accumulated retained earnings plus certain accrued and secured gains such as tax credits for losses carry forward. Tier 2 capital comprises cumulative perpetual preferred stock, other forms of subordinated term debt within minimum maturity of 5 years, which was same as the first one, and undisclosed or non-specific reserves such as asset revaluation reserves and excess loan loss provisions. Let us examine Pillar 2, Supervisory Review. Pillar 2 calls on management to have in place an internal capital adequacy assessment process to quantify both current and future capital requirements. The Basel Committee on Banking Supervision views the supervisory review process as a continued dialogue between bank and supervisor, so that rapid action towards restoration of adequate capital cushion can prevent a bank run and or its failure. For Pillar 3, the market discipline, Pillar 3 sets out the disclosure requirements on material capital information banks should make available to regulators, investors, and the public at large. In line with Basel II market discipline guidelines, a piece of information is material if its omission or misstatement could change or influence as assessment or decision of a user, relying on that information for the purpose of making economic decisions. Later on, in June 2011, Basel III Accord just appeared. The Basel Committee on Banking Supervision issued its new set of official guidelines for bank regulation globally in 2011. Entitled Basel III, a global regulatory framework for more resilient banks and banking systems. Basel III represented a severe tightening of Basel II guidelines for pillars 1, 2, and 3. Furthermore, it imposed two new financial standards, minimum liquidity and maximum nominal leverage, to be met by all banks and established the need for additional capital requirements for the so-called systematically important financial institutions. If we will examine Pillar 1, 2, and 3, for Pillar 1, the minimum capital requirements are written under Pillar 1. Basel III brought a significant increase in minimum capital requirements by restructuring the definitions of Tier 1 and Tier 2 capital and increasing the minimum requirements of Tier 1 capital as a percentage of total risk-weighted assets. It added a minimum capital conservation buffer of 2.5% comprised of common equity Tier 1 capital on top of Basel II's minimum capital requirement of 8% of total risk-weighted assets. Also for Basel III, maximum leverage requirements are written. Stage under 3 stages. So the first stage is supervisor monitoring period. began on January 1st, 2011, focuses on the development of the templates for the determination of non-risk-based total exposure. Stage 2, parallel run period, runs from January 1st, 2013 until January 1st, 2017. During this period, banks were required to calculate their leverage ratios according to the principles and to begin disclosure on January 1st, 2015. For stage 3, consisting of final adjustments to the definition and calibration of the leverage ratio, were conducted between January 3rd, 2017 and June 30, 2017. For formal migration to a Pillar 1, minimum capital requirements on January 1st, 2018, just the beginning of this year. So for the calculation of leverage ratios, the numerator capital measure for the maximum leverage ratio is Tier 1 capital as previously defined. The denominator exposure measure is to be determined according to the following guiding principles. We have 4 steps there. On balance sheet, non-derivative exposures are to be considered net of specific provisions. Financial guarantees or collateral does not reduce on balance sheet exposures. On-balance sheet derivative exposures must combine the present value of the contract, typically 0 at the outset but subsequently positive or negative depending on the performance of the underlying security, plus an add-on for potential future exposure, seeking to ensure that a derivative is converted into a potential loan amount, and contingent off-balance sheet exposures such as acceptances, standby letters of credit, liquidity facilities, command a 100% credit conversion factor, cancelable off-balance sheet commitments by the bank, even if unconditional at any time, must command a 10% credit conversion factor. So you can see that there are some details added under the Basel III, and there's a limitation for the timing for all of the banks that was used all around the world. What is for Pillar 2? Regarding risk management and supervision, the Basel III Accord requires banks to demonstrate to bank supervisors that they are fully capable of capturing the risk of loss from off-balance sheet exposures and securitization activities, and properly assessing portfolio concentration risk, establishing a consistently maintaining incentives for the long-term alignment of risk and return, including adherence to sound compensation practices, stress testing and properly accounting for financial instruments, and consistently operating under a high standard of internal governance, which includes the establishment of well-defined internal supervisory colleges and accountability. Last one is for Pillar 3. Regarding market discipline, Basel III specially requires enhanced disclosure of securitization exposures and sponsorship of off-balance sheet vehicles, enhanced disclosure of the components of regulatory capital with reconciliation to the reported financial statements, and a comprehensive explanation of how regulatory capital ratios are calculated. For this summary, we proceed to study the evolution of international bank regulation as reflected in the three major global accords to date, namely Basel I, reached in the aftermath of the Latin American sovereign debt crisis in 1988, establishing the first minimum capital requirement standards for internationally active banks, and complemented by its 1996 Market Risk Amendment in response to regulated banks' demands that securities portfolios with secondary market liquidity deserve a different treatment that hold to maturity loan portfolios. Basel II, reached in 2004 after 5 years of debate among regulators and banks around the world on how to avoid a repair of the international risk management and market disclosure failures revealed by the Asian in 1997 and Russian that followed in 1998 crisis, and Basel III, reached in 2011 for gradual implementations until 2019, substantially tightened Basel II demands by the imposition of higher minimum capital requirements and the stricter definitions of eligible capital, greater weights for several types of credit, market, and operational risk exposures, introduction of minimum short-term liquidity standards, introduction of a minimum nominal leverage ratio, more explicit demands on top management and boards of directors regarding international risk management processes Pillar 2 and market disclosure under Pillar 3, and for global systematically important banks, an additional layer of capital requirements in the form of an additional loss absorbency capital cushion to range from 1% to 3.5% of total risk-weighted assets. That's the end of chapter 6. Thank you.